The Central Bank of Kenya has lowered its benchmark lending rate by 200 basis points to 11%. This effectively lowers the cost of borrowing in the country as the commercial bank's regulator seeks to spur economic growth.
Meeting for the first time since September, the Monetary Policy Committee observed that its previous actions to lower the benchmark central bank rate from 16.5% to 13% had achieved its desired effects. This, they noted, had been buttressed by falling inflation figures currently at 4.14%, as well as a stable Kenyan shillings against major world currencies. The Kenyan shillings at close of business on Wednesday was exchanging at a mean of 85 shillings to the dollar. With the rate now averaging at 11%, many Kenyans will be hoping that commercial banks too will follow suit and lower their respective rates. Despite the two previous rate falls in the last 4 months, the average lending rate in commercial banks still stands at above 16%. The committee has now cut the benchmark rate by a total of 700 basis points since July, but it seems to have opted for slightly more gradual easing after its record 350 basis point cut in September. With its next meeting scheduled for early next year, analysts are already projecting that the CBR will peak at 9% to the relief of the economy. However, this is underpinned on, among other things, internal and external risks on the economy. Reacting to the rate cut, Standard Chartered Bank Head of Africa Research based in London, Razia Khan, indicated that it will be important that the country accelerates the pace of structural reforms in order to take advantage of the current conditions. Kenya's economy grew at its lowest rate since the end of 2009 in the second quarter of this year compared with the first, prompting some analysts to conclude that the central bank needed to don its pro-growth hat once again. Joseph Bonyo, KTN Business Today.